from Masayoshi Son, it all came down to keeping a tight grip on Sprint Corporation. In his first public comments since ending talks to merge with T-Mobile US Incorporated, the billionaire chief executive officer of SoftBank Group Corporation defended his decision to walk away from a deal that had the potential to transform his two telecommunications companies. "Why did we stop merger negotiations? Basically, we didn't think we should be agreeing to a deal that would result in our loss of control," Son, 60, said at a briefing after announcing quarterly earnings on Monday. "There was just a line we couldn't cross. And that's how we arrived at the conclusion." Masayoshi Son on November 6. Photographer Akio Bloomberg. A wireless telecommunications network will be critical to support investments that Son plans to make via the Vision Fund, a $100 billion investment giant that he's creating with the Saudis and other backers to speed up investments in technology startups abroad. "Having U.S. telecom infrastructure is essential, and we need to keep control," he said. Ever the salesman, Son sought to assuage any concerns by investors that Sprint will be a drag on SoftBank's finances. He has relied on a steady flow of cash from Japanese wireless and telecom operations to fund new endeavors, while Sprint has struggled to return to profit and stem subscriber losses. About half of Sprint's $38 billion in debt and obligations is coming due over the next 4 years, and the Overland Park, Kansas-based company is also facing potentially costly investments into next-generation wireless technology. Sprint's finances are improving, so therefore it will be able to secure funding on its own, he said. Son is, in fact, painting the latest development as an opportunity to double down, hinting that Sprint's shares are undervalued. Even if the next 3 to 4 years will be a tough battle, 5 to 10 years later it will be clear that this is a strategically invaluable business, Son said. With that thinking, we increased our holdings of Sprint. Sprint shares may fall on this news, but that's our chance to buy. On Sunday, SoftBank said it intends to increase its stake in Sprint through share purchases on the open market. The increased holding won't top 85%, the company said. Son has also been negotiating to buy a stake in Uber Technologies Incorporated, the ride-hailing giant. On an investor call Monday, he said the talks are ongoing and he still needs to reach agreements on price and terms. He said if he can't cut a deal with Uber, he may instead buy a stake in Rival Lyft Incorporated. "It is wholly possible," he said. "We won't know until the very end." A Sprint and T-Mobile merger would have united the third and fourth largest wireless operators in the U.S., combining their customer base and networks to create a bigger carrier that could take on larger rivals AT&T Incorporated and Verizon Communications Incorporated. Sprint and T-Mobile jointly announced the decision to end talks on Saturday after Son and Tim Hodges, CEO of T-Mobile parent Deutsche Telekom AG, were unable to resolve their differences over control of a combined company during Friday night in Tokyo, people familiar with the matter said. A key question is whether Son will seek a long-shot transaction with another partner to get Sprint back on solid ground or dig into his own corporate pocketbook to pay for its liabilities, along with network investments that analysts project at about $25 billion through 2021. On Monday, SoftBank reported quarterly operating profit of 396 billion yen, $3.5 billion, topping analysts' estimates, while revenue rose 3.7% to 2.23 trillion yen. SoftBank shares fell 2.6% in Tokyo trading on Monday, leaving them up 28% this year. At this point, maybe Masa has to give up on strategic options and simply invest in the U.S. to make Sprint's network and brand competitive, said Walt Piasek, an analyst at BTIG LLC. Son has already scraped up almost every penny from Sprint's coffers. The company used its airwaves as collateral to refinance debt and turned to handset sale and leaseback transactions to fund customer acquisition. There's little left to mortgage. SoftBank's investors have not anticipated providing the U.S. company with financial support. Sprint's debt is non-recourse to the parent, meaning the Japanese company will not owe anything to its U.S. unit's creditors. And SoftBank, which already carries one of the heaviest debt loads in Japan with 14.9 trillion yen in long-term debt, has shown little interest in offering financial support. Read more on SoftBank's profit swings. Ultimately, Son saw giving up full control of Sprint as antithetical to his view of technology's future. He's invested billions in the past 2 years on the idea that smartphones, cars, roads, appliances and humans themselves will be connected through the internet, generating invaluable data to be analyzed with artificial intelligence and machine learning. He sees a realization of the singularity, where people live with technology integrated in their bodies, sooner than most people think. Wireless and satellite services are central to bringing that all together. Until now, mobile was all about people communicating to other people, or people accessing the internet, Son said. Next, it will be not just people, but things communicating with people and each other. The embodiment Son's bet on that future is the Vision Fund, which has already raised more than $93 billion in total commitments from the Public Investment Fund of Saudi Arabia, Apple Incorporated and other large institutional backers, while SoftBank itself is contributing $28 billion. Even before the Vision Fund, Son used cash from broadband and telecom operations in Japan to fund investments in businesses abroad. He was an early backer of Yahoo! Incorporated and Alibaba. He spent $22 billion to acquire control of Sprint and last year bought chipmaker ARM Holdings plc for $32 billion in the largest deal of his career. The situation for SoftBank is becoming more tangled by the day. Pelham Smithers, whose London-based firm offers equity research on Asian technology companies, wrote in a note to clients. Whereas on the one hand, the underlying value of the company continues to rise, on the other hand, the company seems caught between a rock and a hard place as to its strategy. With assistance by Yuki Furukawa, HID.